Good morning and welcome to Financial Accounting. Welcome back after our spring recess. For those of you who observed the Holy Week last week, I hope you had a wonderful celebration and happy Easter season to you. As we look at our calendar, we'll be finishing up chapter 11 today. We'll be starting with exercise 5 in chapter 11 and finishing up the chapter. So the chapter 11 exercises should be submitted for grading by the end of the day today, ideally. Chapter 11 is the last chapter on our 4th exam. So you can see it follows very closely on the heels of exam 3 because this includes just 2 chapters. So the chapter 11 problem is officially due on Wednesday, and you can take the exam anytime after you finish that chapter 11 problem, but no later than Sunday, April 24th at midnight, and project number 4 is due at that time as well. I had high hopes of getting caught up with the project grading over the break, but I had a few other things on my schedule, and so that has not yet happened, but now I'm targeting this week. If you do have specific questions or concerns about the projects, you are always welcome to ask them, and just let me know if I can be helpful. On Wednesday then, we will start chapter 12, which is not on this weekend's exam, but the chapter 12 pre-quiz should be submitted on Wednesday for grading. We've added a drop-in review session on Friday this week based on scheduling needs. So that Friday afternoon at 2:30, if you are interested in joining us, please sign up in Starfish for that drop-in review session Friday afternoon, 2:30 to 3:30. We can talk about whatever it is that would be most helpful. The exam this weekend covers chapters 10 and 11, so my expectation is we would be looking at materials related to the exam. It could be the chapter 11 problem, it could be the practice set, and as always, if there is content that can be recorded, I would record that and share that review session on YouTube the same way we do for our classes. Looking ahead then, chapter 12, Wednesday, Monday, chapter 13, next Wednesday, and then May 2nd. And then chapter 14 will be May 4th and the 9th. So the 9th will be our last regular day of class, the last day that we cover new material. Wednesday, May 11th is our official last day of class. That is day 30. That will not be a regular class in that there's no new material being introduced. I will open the Zoom link at the regular time. I will be here on campus and I can come down to the classroom if anyone is here and needs assistance. That May 11th is in our calendar as an optional review day. And so you absolutely can use that as review. I would see that as kind of our drop-in review, but you don't need to sign up for it. It'll be on our regular class Zoom link that day. The semester officially ends on Friday, May 13th. And so the last exam, which covers just chapters 12, 13, and 14, will be due by Friday, May 13th. If you have any outstanding work from the semester, it also needs to be submitted by Friday, May 13th because final grades are due. So that is the last day that I will accept new assignments. So everything at that point should be submitted for grading in Cengage, and so that I can do the final calculations of your grade. Any questions about any of that? Okay, so there is no cumulative final. I'm sure I've said that before, but it always comes up that last exam is not a final exam in the way that we think of them, which is a cumulative, on the entire semester. So that exam is just on chapters 12, 13, and 14. Last class, we started chapter 11 on long-term liabilities on bonds payable specifically. We talked about how bonds are priced. We talked about why they would sell at a discount or a premium. Would remind you that there are some reference materials in the Chapter 11 reference materials folder on valuing bonds, finding bond prices. We'll be looking at this today. We have formulas for amortizing bond discounts and premiums using the straight line method. We did that in our last class, and we'll look at that again today in our first couple exercises. I've included this page about the effective interest method, but that is related to the second appendix to this chapter, and you are not responsible for that. So I've left them in here just in case you're interested and wanted to see what the difference between the two methods is. But the only method you are responsible for using for this class is the straight line method. The only reason I've included the effective interest method is because that is the one that is more acceptable. It's always acceptable under GAAP, where sometimes the straight line method is not acceptable for use when you're preparing financial statements according to U.S. generally accepted accounting principles, or GAAP. I wanted to show you in the e-book. So this is the e-book. This is the table of contents for Chapter 11. So here's the Appendix 2 on the effective interest method. You're not responsible for that. We are going to be talking, though, about Appendix 1. And normally, we don't talk at all about the appendices to the chapters, but what's in this Appendix 1 is a very important concept overall, not just as it relates to bonds, but as it relates to other business concepts as well. So we will be looking at this Appendix 1 in our last couple exercises today, and you are responsible for present value concepts in the context of this chapter and what you will see on the exam. The reason I wanted to show you this, though, is if I go back to the index, excuse me, the original table of contents for the book, if I scroll all the way down through, just a reminder, our last chapter will be this chapter 14, but then for those of you who will be taking managerial accounting next semester, which will probably be most of you, we start that class in chapter 15 and cover the second half of the book through chapter 28. What's relevant for us today is this Appendix A. So it's at the very end of the full book, not at the end of a chapter. These interest tables, which are factor tables, are what we're going to be using in some of our exercises today. You do not need to pull up these tables. I can just show you quickly. In those exercises, it has links to little snips of the table, just little pieces of the table that we need for the exercises. So you will not need to pull that up in your book, but I wanted you to see where they're coming from. So what you see in the exhibits that are linked in these exercises are just the relevant parts of the tables that are in the back of the book in Appendix A. So we'll be talking about those tables today and using them in our last couple exercises. You can see here in exercise 9, there's a link to another exhibit that will be used there. And it's just, oh, and in exercise 8, we'll be using exhibit 5 as well. So before we get started with the new material for today, is there anything that anyone wants to talk about from or ask about from last class? So as I was saying, we learned how bonds are priced. We talked about whether they're issued at a discount or a premium and why that would happen. We really went through the first part of the life cycle of the bonds. We looked at recording bonds when they're issued. We looked at paying the interest and recording the amortization of a premium or discount. We'll have a little bit of a review of that in our first exercise here. And then we'll move on to what amounts to the end of the life cycle of the bonds, which is what happens if they're retired early? Why would a company do that? But any questions before we look at our new material? So as I said, we're going to start with exercise 5 here. We're going to do the first part of this together because it is review, get us back up to speed with what we were doing before the week off. And it's been now 10 days since our last class, and maybe 12 days since our last class. And so this will be a good way of getting back into the discussion of bonds payable. This is exercise 5 from chapter 11. Hoover Corporation, a wholesaler of music equipment, issued $20 million of 20-year 6% callable bonds on March 1st, 2022 at their face amount, so there was no discount or premium. Interest was payable on March 1st and September 1st. So we have that unique situation, not a very realistic situation, that the bonds were sold on the first day of the interest period, and so we don't have to worry about any partial period interest. Just to remind you of some of the terminology that we learned before the break, $20 million represents the face value or the principal that's being borrowed. The 20-year is the duration or maturity length of these bonds. 6% represents the face interest rate, also known as the coupon interest rate or the stated interest rate. We've agreed to pay 6% interest on these bonds. It's being paid twice a year or semi-annually. And so we pay 3% interest every 6 months. These bonds are callable, which means that the company can, at their discretion, decide that they want to buy back those bonds. And when you have a callable bond, there is a predetermined call price. Here's the price. And we're told here what that price is. The call price is 102. Remember when we talked about bond pricing before the break, 102 means 102% of the face value. In other words, they sold them for the face value of 20 million, but they are guaranteed to be able to buy them back at a 2% premium over that face value. As I said, though, we're going to start with the first 2 entries, which is review of what we did last time. Any questions about where we are at this point, though? So it tells us we sold them at their face amount. We agreed to pay 6% interest. If the market rate of interest fell from that 6%, maybe it was 5%, we would have been able to sell these bonds at a premium or more than their face value or at a price of greater than 100. If the market rate of interest had increased over the 6%, maybe it's 7 or 8%, then we would have to discount our bonds and sell them for less than the face value or at a price of less than 100, say 95 or something like that. But we were able to sell these for their face value. And so what happened? We received $20 million in cash when we sold them, and we have agreed to pay back $20 million. The bonds payable account is always credited when we sell the bonds. It is always credited for the full face value, no more and no less. If these bonds were sold at a premium, the premium would be the additional amount over 20 million. It would be credited to the bond premium account. If they were sold at a discount, that would have a debit balance and the account would be called bond discount. Our next entry says that we paid the interest on the bonds. So we are now 6 months down the road. These bonds have been outstanding for 6 months. We owe our bondholders a 6-month interest payment. So again, this is review from last time. So you should be somewhat comfortable with doing this type of entry on your own. But we use the simple interest formula to do that. Remember, the formulas that you need are in Blackboard. I just showed you where they were in the reference materials folder. And so you can refer to those if you need to. So the principal is the face value. The interest rate is 6%. That's the stated interest rate. And this is a half-year payment. So that 6% is the annual interest rate. So we need to cut that in half. And so I found the interest would be $600,000. Everyone agree with that? Anyone not agree with that, I should say? And so we report interest expense, and we actually pay the interest. Now the credit side could have been to interest payable if we were accruing the interest, but this actually says we paid the interest, so the credit is to cash. Nothing new there. That is exactly what we had already done. So good review to get us back on track and thinking about the terminology and the calculations required for these bond entries. Everybody feel okay so far? Okay. So let me just get this out of the way and jump over here, and we'll talk about what happens at the end of the life, what could happen at the end of the life cycle of the bonds. So those bonds that we're talking about in exercise 5 were 20-year bonds. The company could continue to make that $600,000 interest payment every 6 months for the life of the bonds. And at the end of the 20 years, with the 40th interest payment, they would repay the full $20 million face value along with that final $600,000 interest payment. We talked about right before the break that some bonds might be convertible, and so it could be that some of the bonds could be converted into common stock at the discretion of the bondholder. We said some bonds could be callable, and so the company may decide, hey, we want our bonds back. There are a number of different reasons a company might want to do that. They might want to save the interest payment. So right now they're making a $600,000 interest payment every 6 months. If they call them in early, they can stop making those interest payments. Maybe they just have some excess cash. They don't have anything else more profitable to do with that cash, and so they decide to retire the bonds. They could retire some or all of their bonds. If the bonds are callable, they are guaranteed to be able to buy them back at the 102 price in this exercise. The price is not always 102. But for this exercise, we're told that the price is 102. It could be that the 6%, again, using the numbers from our exercise, that the 6% interest rate is now too expensive. And so they decide to buy back those bonds by issuing new bonds to take their place at a lower interest rate. Very similar to if you have a mortgage on your house, you might decide to refinance because interest rates have come down. Companies can do that same thing. Basically, they'd be refinancing their debt at a lower interest rate. And that is smart business sense. So in this case, the company is deciding, for whatever reason, that they're going to recall their bonds, call those bonds in at the preset price of 102 and not have to continue paying that interest. If that happens, oh, let me say one other thing too. If the bonds are callable, you have that preset price, you're guaranteed to be able to buy them back. You can compel the bondholder to sell them to you at that price. That's not the only time companies might retire their bonds early, though. They could go into the market, and just like you or I, if I wanted to bond in that company, I could go through my broker. I could go buy up some bonds. I hope you're all aware of what happened with Elon Musk recently in the last couple of weeks related to Twitter. That's what he did. He wanted to buy some more Twitter stock. He went out and just bought up some Twitter stock at the prevailing market price. A company can do that, repurchasing its own bonds. As we'll talk about in the next chapter, they can also do that by repurchasing their own stock, which is part of what Twitter is trying to do right now, because they're trying to block Elon Musk from taking control. So it's not, bonds don't have to be callable for a company to retire them early. They can decide to just pay whatever the prevailing market price is to get those bonds back. Basic supply and demand tells us that the price will go up if there's more demand for it. And if you, again, we're following what happened with Twitter over the last couple of weeks, you saw the price of Twitter go up because there was more demand, because people were buying it. And so you see the price increase. When a company buys back its own bonds and retires them early, they may realize a gain or a loss. And we're going to see that in this exercise and in the next exercise as well. The title of this exercise indicates that these bonds are going to be retired at a loss. And then our next exercise, we'll see what does it look like if there's a gain. If there is a gain or a loss, it does affect the income statement of the company. It will show up on the other income section. So it's not considered operating income, it's additional income. And I thought that there's where it says it. So it will show up not in the operating section, but in the other revenue and expense section of the income statement. But we're going to do our own example, not the example in the PowerPoint. So let's go back to our exercise and finish up so we can see what does this look like when they buy back the bonds at a loss. So then again, you can see that right here. So what that means is they're going to pay more to retire those bonds than how they're carrying them on their balance sheet. This tells us they called the bond issue at 102. Remember, the price of a bond is really an index, which is a percent without the percent sign. So if they called it at 102, it means they paid 102% of the face value. Put the calculation on the screen here for us. So if the face value was $20 million and they paid 102% of the face value to acquire them, that means they paid $20,040,000. Whoops. Yeah, 400,000. My zero's wrong. $20,400,000 is what they paid to acquire those bonds or to get them back. When they made them callable, they agreed to pay 102% of the face value to get them back. Now, if the market rate of interest, or the market price at the time they wanted to call these bonds, if the market price was, say, 101, they wouldn't pay 102. They would just go out on the open market and buy them. But remember, buying them back is going to cause the price to go up. And so when it hits that 102, now they're going to start exercising that call option to keep the price at 102. So they're not going to pay more than 102 to buy them back on the open market when they're callable, but they would pay less than that if they could. Remember back here when we sold the bonds on March 1st, we recorded this bond payable of $20 million. At the time we issued them, we expected them to be outstanding for 20 years, right? Yeah, 20 years. But for whatever reason, 2 years into this, they decide to retire them. Again, we talked about some of the reasons that a company might decide to do that. But when we call them, zero there. When we call them, we can remove the liability bonds payable from our balance sheet. Debit $20 million to basically cancel out this $20 million credit up here. Now this is chapter 11. So we all know as we look at this journal entry that we can't be done here, even if we didn't have this template showing us there's one more line. We know we can't be done because the debits and credits are not equal. So we need a debit of $400,000 to make this entry in balance, to make the debits and credits be equal in total. That $400,000 debit is the loss on redeeming those bonds. It's a debit balance. It looks like an expense, right? So you can think, you can guess already what our next exercise is going to look like. The gain is going to be a credit balance. It's going to look like a revenue, and it will show up as other income on our income statement, where this debit balance loss looks like an expense and reduces our income on the income statement. Go ahead and get our green check marks in there. And so that is what it would look like if the company calls the bonds, or even if they weren't callable, as I said, if they were to buy them back on the open market at 102, the entry would look just the same. So the fact that they're callable is not really relevant to this exercise, except that they're guaranteed they can repurchase them at 102. Any questions about this exercise? All right, well, we will move on. So this next exercise is using the same concepts that we talked about in the previous exercise, only now they're going to call these bonds in and return them at a gain. So what I would like you to do is try this exercise on your own. I'm going to pause the recording and allow you to work through this on your own. I will put my answers on the screen. You can use the check my work button at the bottom once you are done. And when we are done, I will restart the recording and answer any questions that you might have. I'm going to pause the recording now. Okay, so back to this exercise. I haven't hit the check my work button yet because I didn't want all those gray boxes messing up the screen so you can see everything. But we issued the bonds, $22 million face value. We issued them at par. So we received that much cash and we have that much of a liability. We then made the first interest payment 6 months later at 4%. So this is a 6-month payment. We're actually paying half of that, $440,000 for the interest payment. We're then able to call the bond at 97. I just want to point out that's not very likely that the bonds would be issued with a call price below 100. It would be really unusual for a bond to sell at its face value when the call price is less than that, because this is literally what could happen. The bonds are sold for $22 million, and the next day, the company says, okay, now we want them back, and here's your $21,340,000. And the bondholders are saying, but we just paid you $660,000 more than that just yesterday. And the company says, yes, but you agreed we could buy them back for 97% of what you gave us. So you take a 3% loss, it could be literally overnight. So not very likely that would happen in the case of a callable bond, but it absolutely could happen that bond prices fall to 97 naturally because of the change of the interest rates. So we know we issued these bonds at 4%. That's a pretty low interest rate for a corporate bond, even today. And so if the market rate of interest went up from that, the price of our bonds would fall. And if the price of our bonds fell, the company might decide to, on their own, start buying up those bonds to get some of them off the books if they had the excess cash to use for that and nothing else more profitable. So I would say that the call price of less than 100 would be extremely rare because you'd really have trouble selling those. You know, who would take that risk? But that's the exercise we're given. So, and really the reason they did it this way was just so that we could see what it would look like to record a gain on redemption of those bonds. If I had written the exercise, I would have not had them calling the issue. I would have just had them buying them on the open market at 97, so we could see what that looked like a little bit more realistically. So there's exercise 6, issuing bonds, paying interest, and then calling the bonds at a gain or a loss. Everybody good? Let me go back to our PowerPoint just for a moment then and talk briefly about what the bonds payable look like on our balance sheet. So how do we report these bonds payable? Well, of course, they're liabilities on our balance sheet. And if they are due in more than 1 year, if the maturity date is more than 1 year out, they would be considered long-term liabilities. If it's due within 1 year and we expect to use current assets to pay for them, so that's something that's missing from what you see on this slide. If we anticipate using current assets to pay for them and they're due within 1 year, then we would report them as a current liability. The reason I make that distinction is sometimes companies set up, put this term on the screen, what's called a bond sinking fund. We're setting aside some cash in an investment account, basically, so that when the bonds come due, we have the cash available to pay for them. It's possible a company could do that voluntarily just to lower the risk, but it's also possible that a company sets up that sinking fund because it is part of the indenture. And remember that term, the bond indenture is the contract that goes along with those bonds. Here's what's going to happen. Here's the interest rate we're going to pay. Here's when we're going to pay that interest. If they're callable, if they're convertible, that would be included in that bond indenture as well. So sometimes a company that might be a little bit more risky might have to, as part of the covenants or the requirements for their bond issue, they might be setting aside this bond sinking fund just to make sure that they are less risky to the bondholder. And so if there's this bond sinking fund, that would be an investment for the company and it would not be listed under current assets. So the part of the bond that might be due this year would then not be reported as a current liability because they're not using current assets to take care of it, to relieve that obligation. So as we look at the financial statements, as we're looking at the liability section of the balance sheet, you would see those bonds payable. Any remaining premium would increase the total liability. Any remaining discount would actually decrease that liability. So the bond discount has a debit balance, a bond premium has a credit balance. When you look at the notes to the financial statements, you will find, and I'm making a point of this because it's important for your project 4, related to chapter 11, is going to ask you about the notes or the bonds, the long-term liabilities of your company. So if you look on the balance sheet and you can see that they have long-term liabilities, they are required to tell you what those liabilities are, when they're due, what interest rates, and so on. So for most companies of any size, they're going to have bonds outstanding. They might call them notes, and it's really, for our purposes, the same thing. So if they have long-term liabilities, including bonds, on their balance sheet, you will find a note in the accompanying notes. So go to the end of the financial statements and just scroll down page by page. You will probably see a table that shows all of the bonds that they have or notes they have outstanding, the date they were issued, the interest rate, the date that they're due. And so for your project, you may find it useful just to, if you have a snipping tool on your computer, they all do, then just snip a picture of that chart and then paste that chart into your report. That'll be the easiest way for you, because most of your companies will have a bunch of long-term liabilities, including bonds. Any questions about that? Okay. And so this is an example of what that will look like, although sometimes it looks even more like a table with multiple columns of information than what you see here. So this top part is what it looks like on the balance sheet. You can see they have long-term debt obligations. And if I can get this thing out of my way. So their long-term debt obligations right here are 30, these are in millions, but I'm just going to say the number that's there, 30,053. And then in the notes to their financial statements, they detail what those $30,053 worth of long-term liabilities are, when they're due, the interest rates that they're paying. And that is exactly what's asked for in your project. So let's go to our next exercise. And exercise 7, as you can see, is just a multiple choice question based on how we're asking about how are these bonds going to be reported on these companies' financial statements. At the beginning of the current year, 2 bond issues. Simmons Industries had 7% 20-year bonds, and Hunter Corporation had 8% 10-year bonds, and those were outstanding at the beginning of the year. During the year, the Simmons Industries bonds were redeemed, and a significant loss on the redemption of bonds was reported on the income statement. In other words, they paid more to get those bonds back than they were being carried on their balance sheet. At the end of the year, the Hunter bonds were reported as a non-current liability. The maturity date on the Hunter bonds was early in the following year. The Hunter Corporation bonds outstanding at the end of the current year should be reported. So at the end of the current year, if they're due next year, they should be, as we've just discussed, changed to a current liability, assuming that they're using current assets to pay for them. And the loss on redemption of the Simmons Industries bonds should be reported as an other revenue and expense on the income statement. So those bonds are no longer outstanding for Simmons Industries. You would see nothing on their balance sheet for those bonds anymore because they redeemed them. They paid them off, but they incurred a loss, and that loss would be included in the other revenue and expense part of the income statement. We already discussed that. Any questions about that? Okay. So moving on to our next exercise. Sorry, our next topic. I didn't mean exercise. Our next topic. At the end of each one of our chapters, in the last several chapters, we have a way of using the information that we learned about in that chapter to analyze that company, to make some decisions about how is that company doing. As I've told you in earlier chapters, We mostly have not been doing these calculations during class, but I have been mentioning them to you. And our final chapter for this semester, so a couple more weeks, our final chapter, chapter 14, we're going to be looking at each one of these tools that we have, financial analysis tools, to draw some conclusions about how our company is doing, to analyze that company. And so related to this chapter, one of the calculations that we'll be looking at in chapter 14 is the times interest earned calculation, which is really a way of measuring how risky is this company. How likely is it that the company might not be able to make their interest payments or keep up with their debt obligations? And so we're not going to go through this calculation right now. We're not going to do our own example, but you can see that the information here, income before income tax plus interest expense, and there's a special name for that. In finance terms, we refer to that as EBIT. So if you ever watch like a business show, a business channel where they're talking about stock market stuff, how companies are doing, you may hear them refer to a company's EBIT. And that's really what that numerator of that equation is. EBIT stands for earnings before interest and taxes. It was a very special term that we use in finance and very common way of talking about a company's earnings. And then we compare that to that shouldn't say income, I apologize, not that I wrote this, but that denominator, I didn't notice it's wrong. The denominator should say interest expense, not income expense. So we're taking their EBIT and dividing by the interest expense. And so, as you can imagine, the earnings should be a multiple of that interest expense because the earnings have had that interest expense already removed from it. If the company has a loss, if their EBIT is negative, the results of this calculation are not going to be meaningful for you. So we really only want to use this for a company that has a positive EBIT. We're looking for one that's greater than 1, that has earnings that more than cover their interest expense. Remember, we mentioned in an earlier chapter, and we'll come back to this in chapter 14, that anytime we do a calculation like this, we have to compare it to something. Is that a good number? I don't know. Compared to what? So we've talked about in an earlier chapter 3 different comparisons that a company might use. They might compare it to some rule of thumb or a heuristic, a standard that kind of works across the board. That's what this 1.0 is. If we have a times interest earned of less than 1, that's a sign that the company's in trouble. They can't even make their interest payments with the money they're bringing in. We also might want to compare this to, well, what was it last year? Are we getting better over time? And as I've suggested, we also might want to compare it to some kind of an industry standard or an industry average. So we'll come back to that in a later chapter, but I wanted you to be thinking about how that fits in here. What do we do with this information? How do we use this to make judgments or decisions about a company? And now we're going to move on. As I said, our last exercises deal with information from Appendix 1, which we don't normally do, but is important enough in this chapter that we are going to be looking at the appendix. The appendix deals with present value concepts. So what does that mean? I think the easiest way to think about this, if you, and I think I even said this to you last week, if somebody says, I can give you $10 today or $10 next week, which one would you prefer? Most people would say $10 today, right? There's that old saying, a bird in the hand is worth 2 in the bush. It's like that if you have a choice of having it now or having it later, you're going to prefer to have it now. The longer that time horizon, the more clear that is. If I said to you, well, you can have $100 today or $100 next year, clearly you'd rather have the $100 today. if I said you can have $100 today or $100 5 years from now, everybody can see that those are not equivalent, right? That we'd rather have the money today. So what we're learning in this final section of this chapter is, well, how much is that worth to us to have the money today? If you play the lottery or you follow what happens with the lottery, you might already be familiar with this concept. Because if you think about it, you know, when the lottery is at an astronomical number, you know, it's $500 million, and all sorts of people who don't normally play the lottery are buying tickets, and workplaces are going in on sets of tickets and all that kind of thing. Well, you know that $500 million doesn't, if you were to win that, you don't get paid $500 million today. Normally, that $500 million would get paid out in equal payments over a 20-year period, I think is how long they do it. And we're going to see that in one of the exercises we look at here momentarily. So you would end up receiving a total of $500 million over the 20 years, but you have to wait 20 years for that final payment and 19 years for payment, 18 and so on. And so it's really not worth $500 million to you today. Most lotteries give you the option of taking the cash up front, but that cash up front would be significantly less than the $500 million that you would get if you waited and took the payout over the 20 years. Is everyone aware of that? This is not new information, right? I don't expect any of you have ever won a $500 million lottery. If you did and you're still taking classes to improve your mind, that's fantastic. You should be very proud of yourself. But I suspect that's probably not the case. And so, but what we're going to learn is in these next exercises is, well, how much is it worth today? How do they calculate that? How do they know what the cash value of that is? What kind of information goes into that calculation? Our next exercise, let me just go look at that exercise. Whoops, maybe. Let me just get to that exercise here. Our next exercise is the first of 3 exercises we'll do where we're using that present value concept to value a future cash flow. I already showed you that we have 2 exhibits, and I have them pulled up here. Make that a little bigger. Okay, I have them pulled up here so that you can see them. I showed you in the appendix to the entire textbook, not just the chapter, but the appendix to the entire textbook where this information came from. But we're going to be using those tables to do this calculation of, yeah, we have some cash coming in the future, but I'd rather have it today. And so there's a trade-off. How much it's worth to me today, knowing that I have to wait to get it, is going to be less than its future value. So we say that we are discounting those future cash flows back to present value. How much would that be worth to us today? The hard part of these calculations will already be done for us, which is determining this market rate of interest, the percentage or the interest rate we are going to use to discount those future cash flows back to present value. The hard part is knowing the right percentage to use. And for us, that percentage will already be given to us. But what goes into that percentage? So they tell us the current market rate of interest is 4%. But how do we know that? What is the cost of waiting to get our cash flow at a future date? Well, think about it. Right now, as you're probably aware, we are experiencing incredibly high inflation. So one of the problems, if I say, do you want $100 today or $100 next year? One of the reasons you'd say, I'll take it today is because that $100 next year won't buy the same stuff, right? The money is going to be worth less next year than it is now. So there's that the risk of inflation that plays into the appropriate interest rate to use. Another consideration is what's called opportunity cost. And if you've ever taken an economics class, that term might be familiar to you. Opportunity cost is what else could we do with that money? So if I say, yeah, I'll take the $100 next year rather than today, what am I giving up because I don't have that money today? It could be as simple as, well, we could put it in the bank and earn some interest on it over the next year. It could be that you have some debt, maybe you have a car loan or you have a balance on your credit card. And so you could use that money to pay off that debt and save the interest that otherwise you would have to pay on that $100. It could be that you would just do something like, I don't know, buy a couple new video games or something like that. And so the opportunity cost would be the value of what you give up. It's not all of those things, because you couldn't take that $100 and pay off some credit card debt and put it in the bank and earn some interest and buy some video games with it. It's whatever for you is the next best option. Of those, in my example, of those three options I just gave you, which one is the best for you? And what's best for you may not be what's best for everyone else. And so the concept of opportunity cost is really individualized, if you want to think of it like that. So my opportunity cost might not be the same as yours. And certainly I haven't exhausted all of the possibilities of what you could do with that $100. Maybe you put it in an investment account, not just in a savings account in the bank or something like that. So let's look at this exercise. Oops. Assume that you are going to receive $50,000 in 10 years. And I don't know why that is. We could speculate, doesn't matter. But we have to wait 10 years to get that $50,000. So it's not worth $50,000 to you today. It's going to be worth something less than that. How much less is based on two pieces of information. How long do we have to wait to get it? So in this case, it's 10 years. So the longer we have to wait, the less it's going to be worth to us today, right? And we saw, hopefully you caught that as we were talking about it when we started this discussion. If I said, I'll give you the $100 today or next week, it's going to be worth about $100 to you either way. But if I say today, or in this case, 10 years from now, the money today is worth a lot more to you than having to wait 10 years. So two factors, two pieces of information we need to know. How long do we have to wait? And what's the relevant interest rate? And as I said, calculating or estimating what that interest rate should be, what discount, we call that the discount rate. Estimating what that discount rate should be is the hardest part of this. But luckily, we don't have to do that. So this is a single cash flow. Someone is going to give us $50,000 10 years from now. How much is that worth to us today? It's a single cash flow. We had the link here to Exhibit 5, and you'll notice that the heading on Exhibit 5 says the present value of $1 at compound interest. So remember back in the receivables chapter, is that chapter 7 or 8? 8 maybe? In the receivables chapter, we introduced the formula for simple interest. And we've been using it ever since, including to calculate the interest on those first two exercises we did together today. What we're doing with these tables is introducing the idea of compound interest. That is, you earn interest on the interest, not just the principal. These factors that we have here, so what you see, just to explain how this table works, down the left-hand column here is the number of compounding periods. So it doesn't say years or months or days or weeks. But we want to make sure, we need to make sure that the number of periods, how often it compounds, matches the interest rate. So these numbers across the top are interest rates that are going to correspond with these periods. If you are curious, you'll notice in the appendix, in the full table, we have a formula here for how these numbers are calculated. Again, for this class, you don't need to know that. You don't need to use this for this class. But there is an actual mathematical formula that would be useful if, go back to this exercise, if the percentages that we have here don't match exactly what you're looking for, or the number of periods doesn't match exactly what you're looking for. Even in the full table, our number of periods go up by 1 till we get to 35, and then it jumps to 40, 45, and 50. And that's it. So this might be helpful for doing things like calculating investment, the value of investments. In our exercise, the exercise is for 10 years, their first exercise. But what if it was compounded monthly? Well, 10 years would be 120 months. We don't have that in our table. Having the formulas then would be helpful for those situations where our interest rates don't exactly match or our number of periods isn't available. We could use this for calculating interest payments if you're thinking about borrowing for a house or a car. When was the last time you saw an interest rate on anything that were exactly 4 or 4.5%? You know, they're usually like 3.9, or if it's a house payment or a mortgage, they usually go in eighths of percentages, so it might be 5.125% or something like that. Well, this table would help us to approximate, but would not give us a precise or an exact number. And so again, the formula would be helpful when we don't have in our table the exact number of periods or the exact correct percentage. For our exercises, for the practice exercises, for the homework problem, for the exam, you will have a link to an exhibit just like this. The exhibit will have what you need. But for a real world application of what we're talking about here, the table's not terribly helpful. And so knowing the formula could be helpful, or using a financial calculator will also allow you to enter a specific number of periods, specific interest rate that doesn't fall on the table. Questions about where we are so far? Okay. So this is a single cash flow. Someone's going to pay us $50,000 one time 10 years from now, and we want to know how much is that worth to us today. So the formula that we will use, to get my annotate back up here, to find the present value, we take the single cash flow and multiply by, I'm going to use the acronym PVIF, present value interest factor. If you think back to any math class you've ever taken, a factor is something that's used in a multiplication expression. So we're going to multiply by that factor. It's the present value factor because we're trying to find the present value of a future cash flow. So for this exercise then, remember I already said we need to know two pieces of information. How long do we have to wait? 10 years. And what interest rate? 4%. So we go to Exhibit 5, we go to the column that says 4%, and we go down that column to where, oops, here we go. So right here, 4% in 10 years, there's our factor, 0.67556. Everyone see that? 0.67556. So back over here to our calculation. So we take the $50,000, which is the single cash flow, and we multiply by the factor from the table. If you look at that table, the higher the number of periods goes, the higher the interest rate goes, the lower that factor is. All of the factors on that table were less than 1. And it tells us to round to the nearest whole dollar. And so the present value of $50,000 to be received 10 years from now at an interest rate of 4%, the present value is $33,778. Our final question on this exercise, why is the present value less than that? Because there's a compounding of interest. We talked about what the factors that go into that. Opportunity cost, risk is one. Inflation, so the devaluing of those dollars. Everybody okay with? Everybody okay with that calculation? It's a single cash flow. Go back to that table just quickly. As I pointed out, that off the screen. As I pointed out, every factor on here is less than 1. The higher the percentage. So if you go from left to right on this table, in the same row, the factors go down. If you go in the same column and increase the number of periods, the longer we have to wait, the less it's going to be worth to us today. Any questions before we move on? The second exercise here is similar to what I was describing with the lottery. On January 1st, you win $50 million in the state lottery. The $50 million prize will be paid in equal installments of $6,250 over 8 years. I believe that it's, at least in New York State, the lottery, I believe, pays out over 20 years. I don't know that for sure. I don't play the lottery, but I've heard that. So let me just show you. So if we are paid $6,250, $6,250,000 a year over 8 years, that is $50 million. But if you were to say to the lottery commission, okay, but I just want mine now, they're not going to hand you the $50 million today, right? They give you something less than that. This is how it's calculated. Based on the interest rate or the discount rate and how long you have to wait. What makes this exercise different than the last one is that this is a series of equal payments. A series of equal payments. $6,250,000, not paid just once like we had in the last exercise, but paid 8 separate times 1 year apart. That is what we call an annuity. So the root of the word annuity is annu. Think of the word annual. It refers to a year. If you speak French, the word for year is an, A-N-S. It refers to year. So an annuity is a regular payment at the end of each year for a given number of years. So let's go ahead. we're going to be using Exhibit 7, so that's the second table. If we look in the textbook, if I were to just scroll down a couple pages, then we get to a second table, which says present value of an ordinary annuity. You'll notice again, there's a formula here. This formula is a little bit more complicated. And the tables look similar on the face of them before we look at the details. We still have number of periods down here on the left-hand column. We have interest rates or percentages across the top. But what do you notice about the numbers? The first row, yes, is less than 1. But the rest of the numbers on this chart are all higher than 1, are all greater than 1. And so even if we couldn't see the heading on this table, we would know, oh, this is the table for an annuity. We know that because the factors past the first row are more than 1. You should know which table to use in which circumstance. In our exercises, it tells us use table 7, or in the last one, use exhibit 5. But you should be able to determine which one is the correct one to use for the given circumstances. The approach we use, the formula, is basically the same though as what we used in the last exercise. The present value of an annuity, starts with the annual cash flow. So just one of the cash flows, in this case, $6,250,000 times the factor, and you'll notice now I'm labeling it PVIFA, so it's the present value interest factor for an annuity, reminding us we need to use the annuity table, the table that the factors past year 1 are greater than 1, not less than 1. So we need to get the factor for this exercise. We're going to be using Exhibit 7. That's the snip from the annuity table. It's 8 years and 5%. So let's go to Exhibit 7 and 5% and 8 years. And you can see the factor right there, 6.46321. Everyone see that? 5%, 8 years. Now we come back to our exercise. The annual cash flow, the amount we're going to receive each year from the state lottery system is $6,250,000. Now you'll notice up here, the first equation that I put on here said, yeah, we're going to get that 8 times. So over the 8 years, we get a total of $50 million. But we agree that it's not worth $50 million to us today. So rather than multiplying by 8, we multiply by the factor from the table, 6.46321. And it asks us to round to the nearest whole dollar. Whoops, hang on, I put the comma in the wrong place. I don't find it very helpful. I need to figure out how to make my calculator put the commas in for me. $40,395,063 because it was 62.5, so I had to round up to the nearest whole dollar. Everyone else get that same number? Okay. So we will receive a total of $50 million, but it's spread out over 8 years. That would be worth to us today $40,395,063. If we took the cash value for this lottery, rather than waiting the total of 8 years to get the payment, if we just took the cash value, That's how much the lottery would give us. $40,395,063. So if you are the lottery winner, we would prefer that rather than using this 5% interest, that they use, say, 4 or 3% interest. Because the lower that interest rate they use for discounting this, the more the present value is going to be, the higher the factor. And again, we saw that in the tables. Whoops, get all that writing off the screen. There we go. We saw that in the tables that the lower the interest rate, the higher the numbers. As you go from left to right, the numbers get smaller and smaller. So we would rather have a lower interest rate than a higher interest rate be used, because that increases the present value of those future cash flows. Okay, so we have now seen in these past two exercises how to use the table if it's a single cash flow at the end of some number of periods, and how to use it if it's a series of regular cash flows where we get paid the same amount every year for a given number of years. What if it was a payment every year, but it wasn't the same amount every year? Well, we would have to discount each one of those separately and then add all those values together. Any questions so far? Let's go ahead to our final exercise for today then and see how this helps us with valuing bonds, finding the present value of bonds. Now, I'm going to remind you that in the reference materials folder in Blackboard, in the Chapter 11 folder, there is a page called Valuing Bonds and Finding Bond Prices. So what we are about to do in this exercise is right here. Find the fair market value or present value of a bond issue. So what I'm going to do in this next exercise to show you how to do is what's right here, okay? Pinder Company produces and sells high-quality video equipment. To finance its operations, Pinder issued $25 million of 5-year 7% bonds with interest payable semi-annually at a market or effective interest rate of 9%. Okay, so we've agreed to pay 7%. The market wants 9% for bonds of similar risk, bonds that are like ours. So what do we already know? Are our bonds going to sell at a discount, at par, or at a premium? Are our bonds pretty attractive if we're paying 7% and other bonds are paying 9%? Are they? Cheaper for us, but if you're buying a bond, no, you'd rather have the 9% one, right? Yeah, so good point. If you're paying the interest, you'd rather pay the lower interest rate. But if you're a bond purchaser, then you want the higher interest rate. So it doesn't mean Pinder can't sell these bonds, but it does mean they'll have to lower the price or sell them at a discount in order to get people to buy them, right? So we talked about that last class before the break, that these bonds would issue at a discount because our interest rate is not very attractive compared to the 9% that other bonds are paying. So we can still sell them, but we're going to sell them for less than the $25 million face value. What we are going to do in this exercise is figure out, well, how much less? How much can we expect to get for them? How does the public value these bonds? And I'm collapsing that because I need more room to be able to do the calculations here on the screen. So how does the public, how does the investor value these bonds? Well, they look at it as, well, what's in it for me? What am I getting from this? So these bonds are going to be outstanding for 5 years, and they're going to pay interest every 6 months. So there are going to be 10 interest payments over the 5 years. And the interest payment is going to be exactly the same every time they pay the interest. So that really fits our definition of an annuity. It's a regular payment, same amount, every period for a given number of periods. So we're going to value the interest as an annuity. I'll just put a note here on the screen. So we're going to value the interest as an annuity. It's a regular cash flow. What else is Pindar going to do for us, though? If we buy these bonds, then 5 years from now, when the bonds mature, they're going to repay the full face value or principal. And so that face value is going to be a single cash flow. Oops, single cash flow. That face value of 25 million is going to be a single cash flow received at the end of a number of periods. So really for this bond issue and most corporate bond issues, there are two separate cash flow streams here. The interest every 6 months over the life of the bonds, and then the principal or the face value at the end of the life of the bonds. Any questions, everyone with me, and everybody good so far? Okay. Well, let's figure out how much the interest is. So it's simple interest formula. There's the principal, there's the interest rate, and these are 6-month payments. So we're going to multiply by 1/2, cut the interest, the annual interest in half. So how much interest are we paying? $875,000 every 6 months for the life of the bond. These are 5-year bonds. That means there are 10 interest payments. In total, we are going to pay $8,750,000 in interest in total over the 5 years. Okay, but as we've already established, $8,750,000 spread out over 5 years is not worth $8,750,000 for us today. And so we need to find the present value of those future cash flows. The formula is the single cash flow times the factor. And the factor is based on, the number of periods. So it's a 5-year bond, but we pay interest 10 times every half year. So when we go to Exhibit 7, and please just ignore my blue writing there, we can see around it hopefully. When we go to Exhibit 7, which is the factors for an annuity, we're going to use the interest for a half year. 7%, is this, do we have different tables? I'm going to have to, maybe there's a different table here. Well, how did, oh, whoops, hang on, nope, I apologize. So the interest rate we're going to use, and I don't think I misspoke, I think I just didn't say this yet. The interest rate we're going to use to discount this is based on the market rate of interest. So all of the exercises we've looked at up till today, or up till now, they sold at the face value. They sold at par. But remember, we said we know these bonds are going to sell at a discount because the market rate of interest is 9%. I forgot that we had a different rate of interest here. So we use that market rate of interest because that's what investors are demanding. So we're going to use that market rate of interest to discount these future cash flows. Now we can go to exercise 7. I just forgot about that. Half-year interest rate, half of 9% is 4.5%. So we're going to use the 4.5% column, and we are going to get 10 interest payments every 6 months over 5 years. And so the factor we're going to use is right here. 4.5% interest, 10 payments. 7.91272. I wrote it down so I didn't have to try to remember it. 7.91272. So we take our single cash flow, 875,000, and multiply by 7.91272. The $8,750,000 we get in total interest over the 5 years would be worth $6,923,630 today. Again, those interest payments over the 5 years total $8,750,000, but we know that not worth that much to us today. So we discount those future cash flows back to present value. Then the other cash flow is the principal. $25 million the company's going to pay us 5 years from now. Single cash flow. So we're going to use Exhibit 5. We're going to use the same interest rate and number of periods just to be consistent. 4.5%, 10 periods. 0.643930. 0.64393. Everyone see that? Multiplied by the 25 million is, and get my commas in the right place. There we go. $16,098,258 or $250. So if we are an investor and we are looking at this bond issue and we're trying to figure out how much is it worth to us today, we would do that by adding together the present value of the two cash flows. The interest, which we just calculated $6,923,630, plus the principal, which we just calculated $16,098,250. So we add those two pieces together, that will tell us how much the bond issue is worth to us. If I punch that into my calculator correctly, rather than being willing to pay 25 million, we as the investor would be willing to pay in total 23 million, oops, extra number in there, $23,021,880. We knew before we started this exercise it would sell at a discount because we're only paying 7%. Other bonds of similar risk are paying 9%. We knew it would sell for less than the face value. The last thing I want to show you, so how would the bond be priced? Remember the price of the bonds is expressed as a percentage without the percent sign. It would be the 23,021,880, the present value of all those future cash flows divided by the face value. And I'm just rounding off. So the price of this bond issue, we already knew it would be less than 100 or 100% of the face value. The price of this bond issue, rounding off, would be 92.09. It would sell for 92% of the face value. As I said, so let me just get the green check mark in there. Any questions about what we just did here? Is it okay if I erase what's on the screen? So as I said, in Blackboard, in the reference materials folder for chapter 11, we have an explanation of how that's found. Okay, so this is the explanation for how to find the fair market value or the present value of that future bond issue. And then here is where I explain how then to find the price, how to change that present value into a price for the bond. We divided the fair market value that we just calculated by the face value of that bond issue. Great. So that is the end of our chapter 11 coverage. On Wednesday, we will look at the exam, talk about what's on the exam, look at the practice set, answer any questions you might have from these two chapters. It's the two liability chapters, current liabilities in chapter 10, and then bonds payable in chapter 11 that are on this weekend's exam. Any questions before I stop the recording? All right, well, thank you all for being here, and I will see you on Wednesday.
Have a good day.
You too, thank you.